Okay. Okay. Here we are. Hey, guys. We're not late. Just Dave is in the chat saying, where are these guys? They're late. Probably jet skiing. What do you mean? We literally started at 4:59. Come on, guy. We're right on time. James Sykes is here. Dr. Horton, Roger Weatherford, Pedro, we see you. Brian Gill, Shy Locke, Georgie D. All the gangsters are in the chat tonight.
Did you just say Shy Locke?
That's somebody's name. Riley
No,
Anderson. Yes, it is.
Nope.
Yep, it is. Go back and roll the tape later. What do you want me to tell you? Hamoud, Wall's World, James Dean. You gonna dispute me on that one? I don't think it's the actual. So I'm just saying. All right, guys, welcome to an all-new edition of What Are Your Thoughts? We are your co-hosts. With me tonight, as always, is Michael Batnick. Michael, say hello to the folks.
Hello, ladies and gentlemen.
Super dramatic pause. My name is Downtown Josh Brown. For those of you who are new to the show, we are here to talk about the biggest issues happening currently on Wall Street, in the markets, in the economy, etc. We are super excited to be here live with all of our pounders in the live chat. For those of you listening out in podcast land, we appreciate you too. Tonight's show is brought to you by Public.com and the Public Trading.
I need to tell you, the reason for the pause, I need to defend my honor.
The meter is running, dude.
Okay, I know, I understand.
Okay.
The reason for the pause, sir, is because sometimes you introduce me and then you keep going, and sometimes you tell me to say hello to the folks. So I pause because I don't know which way you're going, okay?
Good improvisation. I appreciate it.
Thank you for your attention to this matter.
Okay, great. All right. Where was I? Public is the investing platform for those who take it seriously. You could build a multi-asset portfolio of stocks, bonds, options, crypto, and more.
That's right, Josh. Plus, for a limited time, you can earn a 1% match on all IRA deposits, IRA transfers, and 401k rollovers. Easy.
Not bad.
Easy.
Not bad. Guys, fund your account in 5 minutes or less. Find out more at public.com/WAYT, as in what are your thoughts? That's public.com/WAYT. Paid for by Public Investing. Full disclosures in podcast description. Okay. Couple of things before we get into topic one. I have like a couple of mini subtopics. Really interesting reactions to earnings. And I know we're going to do a whole thing on earnings, but just like in the last day, it's pretty wild what's going on with some really big stocks. Mm-hmm. I'll tell you the ones that stood out to me. Tell me what you think. UPS just absolutely hammered. The stock is down 5 years in a row at this point.
Yeah, always.
Oh, my God, did they beat the shit out of that. UPS said, hey, no guidance for the rest of the year due to macro uncertainty. It's wild.
You know, this might be the cleanest downtrend you'll ever see. It hit the 200-day about 500 times over the last couple of years. Clean.
So, you know what? I don't get stuck in stocks like this anymore. Like, anyone with using any kind of trendline stop or whatever is just watching this thing fall like a knife. No one's long this stock unless they're completely on fundamentals. Like, you can't be looking at this chart and saying that there's anything attractive about the rate at which people are willing to sell it. PayPal, they smushed it. Spotify down 11%, worst day in 2 years. And Spotify, this is a really weird call, a really weird quarter. Spotify was supposed to do 5 million premium subscriber ads. They did 8 million. But they had a surprise payroll tax because of gains in the stock price that they owe for employee shareholders. And it like wiped out, on an accounting basis, wiped out the profit on the quarter. And they didn't have great things to say about the ad business, apparently. They said we're going to have to use more AI to figure out how to get the ad business growing. So that one seemed deserved.
I want to say one thing about the Spotify thing.
Please.
Spotify is, even after it's in a 20% drawdown, the stock is still up 100%, 93% over the last 12 months. This is still the premier name in the space. And so, It's a giant winner that's giving some back. No big deal.
I would.
I mean, I don't own the stock, so it's easy for me to say, but
Yeah, I'm not in it currently. I would way rather buy this down 12% than sell it. And I'll do you one better.
Go ahead.
It's actually even with this little micro crash, it's still above its 200-day.
Yeah, it looks buyable.
The 200-day is 562. Stock went out at 621. Mm-hmm. So it's like still in an uptrend, which is unbelievable because it's far off the high now. I'm gonna keep this one on my radar. Last one I wanted to mention is Starbucks. Reported after the close, they missed by 15 cents, but the press release was like, our turnaround is ahead of schedule.
Right.
So the stock is higher, and they announced something called Green Apron Service, or they're talking about this Green Apron Service, which I have to ask you, personally...
You don't notice my product placement?
Very well done.
Thank you.
I hate this idea. They want to talk to the customer more. They're going to sunset all of the pickup window stores and only build coffee houses from now on. And they want to have like the employees have to smile at you. Don't fucking look at me ever.
Oh, stop it.
And then they have to, I don't know. I don't want to make eye contact with strangers on the street. Like in this day and age, are people looking for more smiles? Like forced corporate smiles? Does anyone want that? The employees don't want it. And then the writing.
I don't like this take.
The writing of the name on the cup. Does anyone have time for that shit anymore? Is that it?
You got a smiley face.
I mean, why are we making people do that? Grown adults have to take a Sharpie and misspell people's names. I thought we advanced away from that. What part of the customer experience is that enhancing? Is there anyone like, oh, I stopped going to Starbucks, but now I hear they're writing people's names on the cups? So
are you asking me for a reaction to you not liking smiles? I mean, this is nonsense talk.
No, this is his turnaround plan. This is Nichols' turnaround plan. And I guess I feel like it's going to turn around, but it's not going to be because of Green Apron Service.
Okay. Can we talk about the business and not the smiles? So it is 6 consecutive quarters of same-store sales declines. Not good. Yeah. In the U.S., it was negative 2%, and the rest of the world is even worse. But the stock is up 4%. I do own the stock. The stock is up 4% because expectations were obviously worse, implied in the price, and we found that out just in the after hours. Now, it could be that tomorrow. Who knows? But I was looking at this morning. Chipotle's performance and Starbucks' performance since he left.
Horrible.
One is up 20%. One is down 20%.
Yeah. Chipotle is one of the worst stocks on the board. So Chipotle looks like Nike.
Looks terrible.
I think
Nike bounced. Nike bounced, by the way.
Eventually. I think the actual reason the stock is up in the after hours is the biggest overhang on Starbucks, aside from the penmanship of the baristas.
And not enough smiles.
Aside from that, is China. It's their most important international market by far, and they've been struggling there. And they announced that they have received 20 companies have submitted proposals to be their joint venture partner in China. So basically, if you don't have a joint venture partner in China that is Chinese, you ain't going to win there. And that's very deliberate. That's just how that country works. I totally get it. So they can't go it alone in China any longer, or the Chinese-owned coffee houses are just going to eat their lunch. So I think the street is encouraged to hear that they're moving forward with finding a JV partner and signing something that's advantageous to Starbucks shareholders, because the status quo is just it's not going to work.
What else caught your eye?
PayPal was not a bad report. SoFi is getting so much credit just because they're they had great guidance, revenue guidance, 60 or 70 million above what was expected. But it's just weird to see that dichotomy between PayPal and SoFi. They're not identical businesses, but I think their customers are identical. I think the people, right? So it's odd how much credit. So SoFi is ripping. That stock looks amazing right now. And I'm not saying they didn't have anything good to say. They did. PayPal is just getting annihilated. And I don't know what that's another turnaround story that never seems to turn around. We're like in year 3 of the PayPal turnaround, and this thing, every time it gets going, they report earnings and it just is annihilated again.
Yeah.
So those were the big ones that I was looking at over the last day or so. And I know we're going to do some more earnings stuff later in the show, so we can put a pin in that. Can we talk about Trump?
I suppose.
Okay.
I'm disinterested in this topic, but it is your topic, so let's go ahead.
Well, the show is called What Are Your Thoughts? I'm hoping you have some thoughts, because this is probably the third biggest story in the market this year. And the conjecture on Wall Street appears to be that Trump is winning. And Wall Street was, I would say, universally opposed to tariffs, just to a man or a woman. Anyone writing research on the sell side, any strategist, anyone covering companies, just everyone said, this is inflation, this is going to crush the economy, this is going to destroy demand, this is going to lead to layoffs, this is going to lead to huge earnings problems, et cetera, et cetera, et cetera. And it is, but he's kind of getting what he wants from the countries he's negotiating with. And I want to just put this graphic up. So the threats, the 145% with China, for example, all the way on the far right of this graphic, the threat against Vietnam, the threat against Canada, Mexico. As you can see, the imposed tariffs or the agreements are substantially, obviously, better than some of the things that we were most concerned with. And that's by design. And everyone
It's called
knew,
negotiating. Maybe you heard
yeah,
of
it's
it.
how he negotiates. What's like a worst case scenario? Let me throw that out on the table. Okay, so we got through that part. He made a deal in the last 4 days with Japan and then the EU, back to back. The Japanese deal seems unclear that they even know what they agreed to. Chart off, which I think is really funny. There's a handful of articles today where people from the trade ministry or whatever are sort of like, I don't really know if I don't think we are certain of what we're doing. But what the Japanese deal and the EU deal have in common is they both involve foreign countries buying more things from America. So it's not just about tariffs. It's now about like make investments in the United States.
How does that part get enforced?
So I'm really glad you asked that. We'll go there in 1 second. The headline on the Japanese trade deal, before we go to Europe, auto tariffs reduced from 27.5% to 15%. The Japanese automakers actually rallied on that, believe it or not. Japan pledges $550 billion in investment capital under U.S. direction. That's the part the Japanese weren't so sure.
Wait, it's like a blank check?
That's what it sounds like. And there's like profits that go to the United States, or maybe directly to the White House. I'm not sure. Commitments to purchase U.S. goods, aircraft, energy, and agriculture. That's very good. Here, U.S. claims the majority, 90% of returns from the investment package. I don't know if the Japanese agreed to that, but fine. What Japan gets...
That sounds scientific.
That sounds crazy.
Yeah.
What Japan gets, they avoid the 30 to 35% threatened tariff on exports. They maintain access to our markets, greater certainty, blah, blah, blah. Elevated diplomatic status because they're accepting the new framework before Europe and before China and, some other shit. But, like... It's funny to me that like the first headline is like, we have a deal. It was a 70-minute phone call. We closed the deal. And then the Japanese were like, wait, what? But the market doesn't care. The EU deal, you asked the question, like, how do we enforce this? I thought this was a really funny story. Basically, chart off. I'm sorry, guys. So Trump's sitting in the room with the Europeans, and he says, how could we be certain the Europeans won't shrug off their plans after a deal is agreed upon? The EU leaders assure him that their investment plans are real, and Trump goes, his words, prove it, according to one of the people who's in the meeting.
Reasonable.
This is the Wall Street Journal. EU officials rattled off the names of companies they said already were prepared to invest. With a trade deal in place, planned investments of almost $200 billion would grow by even more, they told Trump. At the end of the talks, Trump said he would impose 15% baseline tariffs on the EU instead of the 30% he had threatened. He said the EU would now be investing $600 billion in the U.S. under the deal, including a separate commitment to buy another $750 billion worth of American energy products from the U.S. over 3 years. European officials said the $600 billion is based on private companies' investment. So that's like Volvo is going to build a plant in Indiana. I'm making that up, but like that's what that means. So just on the surface, based on what I'm telling you, doesn't it sort of sound like Trump is winning this thing, given all-time highs in the market and basically getting huge investment commitments from these countries? What do you think?
I do think that's what it sounds like. I mean, that's what the smart people are saying, like Neil Dutta, for example, and he knows more than I do about this stuff.
Yeah, we're gonna take Neil's quote in 1 second because I thought that was really
not much of a market reaction. Like European stocks rallied, which you mentioned already, but
because 15 is better than 30. That's really what it boils down to. And one of the interesting things is that the EU has the authority to negotiate trade on behalf of 27 countries, right? And they don't like it at all, and they're making their opinions heard. We actually have some examples. Benjamin Dusa, who is the trade minister from Sweden, said, quote, the least bad alternative to a standoff. The French prime minister mourned it as a, quote, somber day that he called tantamount to, quote, submission. The German chancellor, the head of the largest economy in the EU, said his country would, quote, suffer considerable damage under the agreement. The Spanish prime minister said he could support the deal without, quote, without any enthusiasm. Hungarian prime minister summed it up best. Quote, Donald Trump ate von der Leyen for breakfast. End quote. So that's the European reaction. The European reaction is fuck it, do it. Let's just be done with this topic. Here's Neil Dutta, and then we can move on. He says, I can't help but wonder that as every academic and critic of the White House lights their hair on fire over the effective tariff rate, America is taking some steps to rebalance our economy. For the PhD academics losing their minds, the issue is that this is a win in the traditional sense of the word. Entering a hot dog eating contest might be stupid, but if you eat the most hot dogs, you win. So Neil kind of likens these tariffs to having the same effect as a consumption tax or a VAT tax. I think that's the right way to think about it. When you listen to the company calls today and yesterday and the way that they're talking about how they're dealing with tariffs, they're eating a little bit of it. They'll pass a little bit of it on. It ultimately takes the form of like an invisible, it's visible, but an unitemized VAT tax. The more you consume, the more of these tariffs you're going to end up paying. And wasn't, it's the White House doesn't frame it that way, but like that's sort of how it turns out to be. Okay.
Well, if it had to be, I'm glad that we won. I don't like tariffs, and I wish that we never did it. But if, I'm a patriot, and I'd rather win than lose. But who knows what sort of ramifications it's going to have long term. Like, these are our biggest, most important trading partners, or at least certainly near the top of the list, and you're forcing them into submission and really pissing them off. I hope it all works out.
Yeah, I think it's not even just the long-term thing. I think it's long-term, but then it's also like we haven't really seen a material pullback in spending across the board, but there are certain categories where this stuff is just, it's making people switch to something else.
Yeah.
And you might say, good, switch to something American. All right, there'll be some of that.
Listen, I hope we look back on this and say we were all making a big deal out of nothing. We switched, and the world went on. That'd be my hope. All right, speak to moving on. Let's do that. So last week or the week before, we were talking about semiconductors, and the AI trade is powering everything. That is where it starts and stops, this market rally. It is not being powered by the consumer. It is not being powered by anything other than artificial intelligence and the hyperscalers continuing to spend.
Was I early to this?
$500 billion. Yeah.
I think I was. I was saying like 6 months ago, the only thing that matters is AI.
Yeah.
And it's kind of like everyone just accepts that now.
Well, it does, because the market is making all-time highs as earning expectations are making all-time highs, and embedded in those expectations is monster profits from NVIDIA and the likes. And so that's it. That is all that matters right now. But getting back to the question, can the market rally without semis? I honestly do find it hard to believe. Not forever, but like for today, that is what's powering the market. But Chart Kid Matt made something interesting. This is a question that we've asked in the past. It's not the first time we said, can the market rally without? So chart on, please, John. Here's Apple, and we're showing that Apple's weight in the S&P peaked, and in my estimation, it will never be higher than it was. It was 7.8% in the summer of 2023. It is now down. This is a big change. Its weight is down 27% from 7.9% to 5.7%.
That's a big deal.
And the market, it's a big deal. And the market is up 40+% over the same time. Not an apples to apples comparison, pun intended, but just, an interesting thought experiment.
So I think that market cap went to NVIDIA and Microsoft.
Mm-hmm.
Like I think it's that cut and dry.
Yeah.
Like almost like a direct transfer. Microsoft is going into its earnings tomorrow at record highs. Its market cap is up by a fifth in the last 2 months. That came right out of Apple. Like, would anyone dispute that? The money did not come out of Apple and go into Wells Fargo. Like, I think we all sort of understand that large cap managers who are invested in the AI theme are pivoting to NVIDIA and Microsoft and away from Apple. And they may pivot back, but like that market cap doesn't disappear into the ether. I'm one of these guys who has to know, where did it go? That's where it's going.
Yeah.
So,
however, if there is a moment in time.
Wait, put Matt's chart back up. Ask the question: do we need Apple in a bull market?
Well, no. The answer is no. I mean,
we know that we don't, but we do need an Apple replacement. like you need another mega cap.
That's right. We need leaders.
Microsoft. So for the listener, for the viewer, I don't know when the last time you looked up Microsoft's market cap. You probably think it's $2 trillion. It's actually about to be $4 trillion. So, do we need Apple in a bull market? No, so long as we have blank. And in this case, it's NVIDIA and Microsoft. Like, they're passing the torch back and forth. Mm-hmm. That's what's happening right now.
But would you agree the biggest risk to the bull market, at least in today, it's disappointing AI numbers or guidance, obviously. That's it.
I think that's the biggest near-term risk to the market, that one of these, and we've said this, one of these companies shocks Wall Street with like a guide lower because they're spending too much on AI. Like an earnings shortfall because they just don't have the ROI from the investments they've been making. And
not yet. It will. It's not
happening yet.
It's not yet. No. Google just upped their guidance, their capex by $10 billion. It's not happening yet. It'll happen eventually, but not yet.
Correct. So, but that is the day that happens. You literally could see a circuit breaker on the Nasdaq. Mm-hmm. If it may never happen, maybe all of this spending is super profitable, and they'll outrun that concern. But
I'm pretty sure that at some point in the future, don't quote me on a time, we will get ahead of ourselves if we're not there.
It's just crazy to me to have like bellwether stocks for the real economy, like Chipotle and UPS, just like dive bombing to 52-week lows, and people saying the consumer is holding this up. No, it's not.
It's not. It's hyperscalers.
Stock market Americans are holding up the entire thing right now, and stock market American spending is being fueled by the wealth effect created in Silicon Valley as a result of the AI CapEx race. And that's it, and there's no other story. I don't give a shit what you think. There isn't. And I can't imagine people don't see that connection. Now, this will age really poorly if we never have that moment. And the economy, the overall economy reaccelerates, but
we will have that moment. At some point, there will be a disappointment. Obviously, that's where the stock market works.
Callie did a thing on her site today. I think this is right. She's like, if you own the SPY, like a third of your portfolio is now in 3 stocks. Mm-hmm. Like that's what's holding everything up right now. And what's so funny is there's a lot of circular spending going on. Like Meta and Microsoft are the ones buying all the chips from NVIDIA. NVIDIA is selling those chips, and the end customers are spending on all this cloud compute in return right back at Microsoft and Meta. Like it's extremely circular, and I don't think the extent to which that's holding up the market is fully appreciated. Everyone's like, yeah, tech is dominant. Man, if this goes into reverse, I don't know what catches us.
Yeah.
But there are no stocks big enough, is my point.
Yeah.
There are no stocks big enough. Apple reports this week. Let's do like a couple of quick previews here. During the previous quarter, Tim Cook said the tariffs could add $900 million to Apple's costs for the Q3 fiscal quarter. Well, I guess we're about to find out because we're there. Revenue expected $89 billion, which would be a 3.7% year-over-year gain and a 2.1% gain in earnings per share. Barely growing.
I mean, this is just not a growth stock. Hasn't been for a while.
Barely growing. Let's put this chart of the EBIT up. Here's the quarterly year-over-year growth in cash flow.
Yeah.
It's like effectively nil. All right. Microsoft, a little bit more of a bright spot. $73.8 billion in revenue expected, $3.38 in earnings. That would be 14.1 and 14.5% growth, respectively. And if they do those numbers, this company is just incredible. Last quarter, they beat on the top and bottom line. Let me see what else I would say. Oh, Azure revenue growth. Last quarter, it was 35% year over year, hedging out changes in currency, which was better than the 31% growth. This quarter, analysts are looking for the same thing, 34 to 35%. And they've already guided CapEx to be $80 billion for the year.
John, throw that chart on. The CapEx
chart?
one.
Yeah.
This is it.
Yeah.
This is it. This is the entire story. We're looking at CapEx to revenue. We shared this chart a couple of weeks ago. But if you're listening, it's Microsoft, Alphabet, Amazon, and Meta. Notably absent is Apple because they're just not spending any money. But these companies are supporting the stock market. And as long as they got higher, and if you think that Microsoft and Meta are going to be out of step with what Google said last week, you're crazy.
No way.
Not going to happen.
Meta is the same night, expecting revenue of $44.8 billion. That would be a 14.8% year over year. Earnings should be up 13.5%. EBIT should be $17 billion, up 14.6%. Meta has grown operating income in the last 3 quarters, 46%, 39%, and 31%. They already increased the midpoint of their CapEx guidance. Also, they were at 62.5 to 68 billion in April, and they raised it. So that's all this week. Gun to your head, and Amazon, which we previewed last week. We jumped the gun a little bit. We don't have to do that again. Gun to your head. Which one of these is going to have the best? I won't even say report, but reaction. You have to pick one.
Yeah. Not Microsoft, just because the stock is just perfect. There's no hiccup. I would say Amazon.
Okay. I want that to be right. I think it's going to be Meta. And I'm purely basing that on the advertising numbers from Alphabet last week.
I hope you know what? I hope all these stocks get hit, frankly.
I'm not in it. It's fine.
No. I don't want anybody to lose money, but we need a reset. Just a little bit of a reminder of what risk is like. The desert needs water. People are out of control.
I wonder if the analysts are going to push Zuckerberg on some of the hiring that he's doing. Like, he's giving people billion-dollar salaries. Like, I wonder if anyone's going to be like, so hold on, you're just going to acquire every AI startup or take 50% stake or whatever? You're just literally going to spend billions of dollars on acqui-hires? And I want to hear him say, yeah, that's what we're doing. Because that's literally what they're doing. It's insane. They're building this meta super intelligence thing that is like the new thing they're calling their AI effort. And they are just going out of control, like recruiting people out of everywhere and paying top dollar. And I wonder if anyone's going to ask them about, like, is that sustainable?
John, we
And-
have that headline from Apple. Keep talking, Josh.
What's the headline?
All right. So Apple has lost its fourth AI researcher in a month to Meta, marking the latest setback to the iPhone maker's artificial intelligence efforts.
Who the fuck is that sitting in the chair? Is that an
Is
AI?
that Jeremy
that's
Irons?
That's an actual person?
I don't know.
Look at the head.
But no, this is
when
like-
I have gray hair, I want to have hair like that.
that is a delicious head of hair. Tim Apple is obviously going to get a lot of questions about like what are they doing?
Well, is it sustainable? And the last time they embarked on like a spending spree like this, almost completely unchecked, was the metaverse era. And it only took like one or two really scary stock price reactions for them to knock it off. And they eventually
took a
knocked
while.
it.
Took a while.
You think so? I
No,
feel
know.
like it took two quarters. It took two quarters.
No, it took a while.
Really?
Yeah. Anyway, let's keep it moving. Let's do some more earnings stuff.
All right.
Let's do growth reactions, etc.
All right. I asked Sean for this and Chart Kid Matt, two of the GOATs at Ritholtz Wealth Management. Well done, boys. So far, 168 S&P 500 companies have reported. That's going into today. So there's more. But just to give you a flavor, this week we're going to get 162 reports. So this is a really, really big week. It's like the Super Bowl. In addition to all these Mag 7 names, you also have a Fed meeting and a GDP report thrown into the mix. Jobs report on Friday. Blended earnings were for the S&P 500, which is actual plus estimates, up 4.5% year over year, which is 171 basis points above estimates at the beginning of the season. So that's good. 5 of 11 sectors posted a year-over-year increase in profits. What is this chart? Oh, this is the blended earnings growth. So you can see, like, it's about half and half, but all the market cap is on the left side. Communication services, tech, financials, these are the biggest market caps in the market. These are the ones that matter most. And they are holding up the market, quite frankly.
Yeah.
The only reason we're at a 22 multiple. Let's do the sales growth. Next one.
Can't fake sales.
So the only sector with negative sales is energy. But again, that's like hugely commodity dependent. It's very noisy. And it's not really the way to think about those stocks. But every other sector, blended, is seeing year-over-year earnings growth, revenue growth. Last one is actual earnings growth. Energy negative 25%. Technologies plus 17.2. Communication services plus 17.2. It's AI. Like I don't know. And people are like, well, financials isn't AI. Yes, it is. Yes, it is. All these bull markets that these financial companies are feasting on are directly related to AI. It's all one trade.
It's all AI. By the way, speaking of AI, I was out to
I
dinner.
think we
with,
agreed to AOI.
Nah, I like AI. I was at dinner with Dan the other night, and his ETF. Guess how much is in the Ives ETF? He launched this when? July
Last week?
16th. Holy shit! It just launched. Guess how much?
300.
400.
No way. Really? Oh my
And then
God.
he's like, we're. I don't want to say anything else, but it's unbelievable. $400 million in like 2 weeks.
Did he pay for dinner? It's pretty, dude. That's impressive.
Very impressive.
All
All right, next chart.
On this show, we root for Dan Ives.
All the way.
All right. The beats are being rewarded at pretty much an average of 1.1%, which is pretty good. The misses are being annihilated. Like the huge rally, we had a 30% S&P rally off the lows of April, and the market is saying like, okay, we gave you the benefit of the doubt, show us the number. And God help you if you miss by a penny or two. They're taking stocks down by an average of 5.2%. This is the worst one-day price reaction for missed earnings. You have to go back to Q1 of 2017 to find a more punishing environment. So you have an 82% beat rate, which is good, above average, but God help you if you miss like UPS. They are carrying you out feet first. And I bet you that continues. I don't think that's gonna change. I think that's gonna be the story of this earnings season. We gave you the benefit of the doubt. Your stock price rallied 20, 30%. You better put up. And not every one of these companies will. Which brings me to my question for you. Do you think by the time we get to the tail end, which is NVIDIA, do you think this will have been a successful earnings season from the standpoint of like, all right, we may not have made new highs, but we held up, like we held the gains? Like what? Like how
Yes.
do you think that'll be the perception?
Yeah, I do. I don't think it's going to
really-
be a debacle.
You really need this week's Mag 7 earnings then to be good.
Yeah, and I expect them to be.
What if they're not? It's another correction, right? Like another market-wide 10%.
When you say they're not, I think it depends less on the numbers and more on what they say, more on guidance.
I think it depends more on the reaction itself.
I'm saying, but
I-
the reaction will be a function of guidance, not what they did last quarter. I just don't see them being like, whoops, we
No,
got over our skis. I just don't see it. Like it's still so early, and based on everything they've said for the last couple of quarters, the idea that they're not going to affirm or continue could happen. I just don't see it.
Heather McFarland in the chat is reminding me of something Dan said. Something like, it's 9 p.m., but this party goes all night long or something. How did he, remember he said that? I mean, I know he
don't.
said that a bunch of times.
Okay.
Or something like, it might be midnight, but this thing goes all night, or something, something hilarious like that. All right, I guess it's too early for the Mag 7 to materially disappoint. So as long as their guidance is good, this should go down as like a good earnings
I think
season.
so. But also, listen, the VIX is at 15, and people are going out of their minds speculating. If we get a little slap on the wrist, like, all right, I'm here for it.
Yeah. All right. The weight loss drugs are crashing. This bull market it's way past midnight. This bull market is now in a complete and total hangover from whatever went on last year. These stocks are just being destroyed. So Novo Nordisk, I guess, came out with an earnings report over in Europe, and man, they crushed this stock. It fell as much as 30% at one point, wiped out $93 billion of market cap. And the problem for Novo, and we've been talking about this on the show, like we did a whole thing about HIMSS being sued, being like having a partnership with Novo Nordisk break apart over generic sales of semaglutide and tirzepatide, and all of these compounders that are knocking these guys off. Well, it's like having a huge material effect. This company just lost $100 billion in market cap because of this. Novo cut their sales outlook, now expecting 2025 sales growth of 8 to 14%, down from the high end of the range was 21%.
Oof.
Yeah, really bad. Said operating profit would be lower than previous forecast. This is the second time they've cut their forecast just this year. Chalked up the diminished outlook to the availability in the U.S. of copycat versions of Wegovy. The company said despite U.S. regulators recently ordering an end to the practice known as compounding, it has continued with multiple entities still marketing and selling unbranded versions of semaglutide, the main ingredient in Wegovy and Ozempic. So they have to this is just going to be lawsuits, law enforcement, maybe I don't really know. I don't know what they're going to do. I don't know if the FDA gives a shit, really. I feel like there are probably thousands of companies in the United States and around the world just making their own version of this drug and selling it. They're all running advertisements like crazy. HIMSS is a really good example. HIMSS has the distribution. Novo has the patented product. Which would you rather have right now? I think you'd rather have the distribution. Mm-hmm. If the consumer doesn't give a shit and they're willing to buy knockoff version, then you'd rather have millions of customers that are hooked into your website than have the stupid patent. What good is that? So that's crazy. We have some charts. I want to show you. This is Novo Nordisk versus its market cap. Michael, the losses here are staggering. This was almost a $700 billion company, and I think it was the largest market cap in all of Europe for like 5 minutes last summer. Do you remember us talking about that?
Yes, I do. Yeah, the stock is down by 2/3. Tough.
It's a $240 billion market cap and still dropping like a rock. And that's not over 3 years. That's over 6 months.
Yeah.
It's wild, right? Okay, here's Eli Lilly. Not as bad. Eli Lilly almost hit $1,000 a share. It's been flatlining. It's in a 17% drawdown. But compared to how much it had gone up since 2020 when this weight loss craze started, that's not terrible. It just looks like a pullback. Let's show this in isolation.
Man, to me, it looks very heavy.
I'm not buying it.
It looks
I'm
like
not buying it.
It's going to 600.
Next chart. This is just the share price. So it's at 776. Again, it was almost 1,000 last September, and it's it's not looking good. All of these rallies are sold. You have this persistent pattern of lower highs, not what you want to see, and they're fighting the same battle that Novo Nordisk is fighting. They might be better at litigation or something, but like the trend is definitely against these guys. So I don't think this is the type of blue chip stock being down 17% that I'm like, yeah, I can't wait to buy it.
Agreed.
In the chat, they're saying Novo should donate $1 billion to build Trump golf courses. Suddenly there would be aggressive enforcement. Yeah, you know what? It's obviously hilarious, but like, I wonder if Novo Nordisk, outside of the general pharma lobby, has any power whatsoever to make this stop. Because I don't know what kind of money is being spent on the other side by the compounders to have it continue. It might just be a lobby battle until somebody gets serious about enforcing this stuff. And in the meanwhile, these stocks are just absolutely fucked.
All right, let's rewind the clock. I feel like stock market investors always, but especially in 2025, have a very short memory. There's a lot of risk taking, a lot of speculation, and how quickly we forget what we just lived through 3 months ago. Ryan Dietrich quote tweeted this tweet from back in May. This is in May 2nd, so I guess a month, 3 weeks after the bottom. Goldman said, markets might not have bottomed. Wells Fargo could retest the lows. Morgan Stanley retesting the low end of 5,000 is feasible. JP Morgan sees S&P falling to 4,000 in worst case scenario. Bank of America sell the rebound in U.S. stocks. So Yahoo Finance put together this banger of a chart that shows how the 2025 price targets have evolved over time. And like they always do, I'm not throwing shade. This is the job. It's impossible not to do this. I would have done the same thing. You follow the market. So you had the initial forecast coming into the year. They were all pretty aggressively bullish, and why wouldn't they be? And then you had the tariff reaction and the freak out, and of course they lowered their estimates. And just like that, they're back to where they started, if not even higher. We could skip the next one.
Wait. Can we stay here?
Sure.
So Wells Fargo and Morgan Stanley never changed their target.
Good for them.
They just like wrote it out and were the last to react. I guess my question to you would be, why wouldn't everyone just not react? Why do they have to? I know the market fell a lot.
I think because when you're 20% above or below your year-end target, it just looks like sort of ridiculous. I think maybe. What other defense could there be?
Doesn't this look more ridiculous?
Well, yeah, with the benefit of hindsight, but
but be the last to downgrade then. Who gives a shit? No one's like. In other words,
I understand what you're saying.
Like game theory. In the next 20% bear market, like, you know what? We didn't save anybody any money anyway. If we downgrade now, what if we just don't?
Yeah, that's not how life works. But touche.
No, but you see what I'm saying?
Oh, I see what you're saying. I understand.
From a pure gamesmanship perspective. All right, we could downgrade it now, and maybe it falls further. No one's going to give us credit for that.
I agree.
If
you're not first, if you're not first, you're last.
Yeah, or just don't even bother.
Right. So Dietrich tweeted that the S&P is up 8.6% year to date. It's about average. And then Balachunas just, no notes, just a perfect 10 out of 10 response. Eric said 8.6% is amazing, given the amount of negative headline firepower thrown at the market by the media. Adjusted for that, it's up like 30%. Yeah.
Wait, so in other words, it's an average year, but like, what is he saying? 4 out of 75 years, stocks have gained 8 to 10%. Like we almost never have an actual average year. Is
All
what
right,
you're
so
saying.
we never have an average year because when the market is down, on average, it's down 13%.
Right.
When the market is up, on average, it's up 20%, 20 plus percent. When you net those two out, yeah, it's like 8 to 10%, whatever it is. But I don't care about that. I care about Eric's point is that when you think about how black it got in April, everywhere, the fact that we're up 9% of the year is pretty remarkable.
Again, I know we're beating this dead horse, but it needs to be said over and over again, at least for future posterity. Pull the XLK out, pull the XLC out, and we are negative on the year.
Of course,
Like,
yeah, no doubt.
So it's only a plus 8.6% year because of this once in a lifetime CapEx explosion, thanks to a software program that nobody saw coming as recently as 3 years ago. Like that's it. There's nothing else going on that could possibly have this market up 8.6%.
But maybe that's the
Must
thing about a bull
acknowledge it.
market. There's always something else. There's always something that bails us out.
Yeah, but this felt like one of the all-time kick saves.
I agree.
And we can't run it back a different way. Like there's just what it is. There's no counterfactual. You can't prove it. Because people would say, well, what if something else came along? Yeah, maybe.
Yeah.
I don't know. All right. IPO. Did this go public? Is this going public tomorrow?
Figma
say?
on Monday raised the preliminary pricing.
It's not out yet, but I'm trying to think. I think it's this week. There's a few reasons why this one's notable. Okay, you and I used Figma when we were working with the company that built our last website. They used Figma as the design doc for us to all go into and point out like mistakes in the design before it became live on the website. So that's the way Figma is used. And it's definitely a competitive space. They don't have it all to themselves, but it's a pretty big company. This is Martin Pierce at The Information. Sometimes good things happen to nice guys. I'm talking about Dylan Field, one of the more grounded founder CEOs you're likely to meet in tech. His design software firm Figma looks to be sailing toward a very strong public debut in the next week. Figma raised the preliminary pricing range for its IPO Monday to between $30 and $32 a share from an initial range of 25 to 28. At the upper level of the new range, it's a market cap of $18.7 billion. Blah, 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 blah. It's a 48% revenue grower. It's got like a lot of the attributes that people are looking for in a software stock. There's a lot of deep client capture, et cetera. All your designs are already in there. Why would you switch providers? Like we like these types of stocks. It's definitely at risk of AI doing what they do better and cheaper and faster and blah, blah, blah. But then, of course, this is the kind of company that will say, hey, we're going to do our own AI and our product's going to improve. So I think it's notable that we can still get these $18 billion tech stocks to market that aren't even AI plays. It's just a design software company. But I like that we're still seeing deals.
Well,
And,
I love that line. Dylan Field, one of the more grounded founder CEOs you're likely to meet. Nobody would ever say the same about you, and it's great to see good things happen.
What the fuck?
Yeah, you love seeing good things happen to good people. But wait, there's more. Throw this tweet up, please.
I'm not one of the more grounded tech CEOs you know.
No. All right.
Okay.
Jeff Richards. The last 5 technology IPOs are up 142% on average.
Amazing.
That's kind of wild. The last
Amazing.
20 are up 93%, performing well beyond the lockup window. So he said the last 12 months, the prevailing narrative was there is no IPO market. Well, smart companies prepared anyhow and were ready to take advantage of favorable conditions. So you love to see it. This is really, really important to a functioning capital market that these new companies can be treated well by public investors. We need more of that. So
Yeah,
stuff.
you never know when the window's going to be the window's going to reopen. A few good weeks in the Nasdaq, and they're doing deals again.
Yeah.
So that's exactly how it works.
All right, so I am going to make the case that everybody needs to be cool. Maybe no more new positions for a minute. Let's let the market breathe. We have just had a spectacular run. The VIX is at 15. We're seeing a lot of silly behavior. And I'm not telling you to sell your 401k or stop anything like that. I'm just saying for individual positions, if you're feeling strong, relax. The market has been on fire. You, all of us, we're not geniuses, so just take a breath. And I brought data. So, a few tweets from Bob Elliott. Not trying to be a Debbie Downer, just trying to be a little bit sober here. Speculative trading indicator, the 3-month rate of change. We've seen this twice in previous history. At the end of the dot-com bubble,
It's a great chart.
and at the end of the 2020-2021 mania. Okay, that's number one.
Wait,
Number
keep
two.
that up. Look at this. This is as clear as a bell.
Yeah,
The implication is maybe it goes further,
just calm down.
but not much further.
No, it might. You never know. All right, here's another one. Quantitative analysis from Bob, or I guess it was from Goldman that Bob tweeted. Stocks typically underperform after sharp rises in speculation, which is pretty intuitive, right? So they're showing sharp increases defined as a 3-month change in the indicator exceeding 15 points, or roughly the top 5% of observations since 1990. And they show what happens 3, 6, 12, 24, 36 months later. And it's not a catastrophe, but you would expect a little bit of backing and filling. Another thing, this is from Jason Gepford, a sentiment trader. So Helene Miser tweeted that the S&P at new all-time high and fewer than 100 stocks making new 52-week highs. So what that means is this rally is fairly narrow. It is AI and only AI. And Jason shows that when that happens, especially when it starts to cluster, where you see new highs with fewer and fewer participating stocks, on average, returns aren't great. Not catastrophic, but just not great. So my point is, we're all having a great time. If you're in individual stocks, unless you're in the bad ones, you're making money, and just pump the brakes a little because the wind has been in our back for the last 3 months off the lows, really uninterrupted, and we're extended, to say the least.
I got another thing here for that. Jim Reed is the head of macro and thematic research at Deutsche Bank.
Ooh, research. Okay, now you have my attention.
Yeah, research is like finance. When I
Yeah,
say
yeah,
it,
totally.
better pay attention.
No, I'm leaning in.
We're back to a boom in margin debt in the stock market. So this is investors borrowing against their own stocks to buy more stocks. So it's not like borrowing in general. This is
Don't
specific.
margin debt me. I mean, of all the
I'm
things.
I'm talking to the listeners. I'm talking to the viewers. So this is like borrowing against stocks to buy more stocks. Okay, the level of margin debt accumulated on the New York Stock Exchange in May and June was the 5th largest 2-month increase since 1998. So we're talking about the rate of increase.
Okay, so people are going nuts. People are going crazy.
The only periods with larger 2-month increases were right before the 2000 dot-com bubble burst and right before the 2008 financial crisis. Quote, while the current surge doesn't quite reach the extremes of those prior episodes and could therefore easily climb further, it still ranks among the most aggressive 12-month rolling increases on record. More ominously, perhaps, quote, margin debt, listen to this one, as a percentage of GDP now exceeds levels seen in both 2000 and 2007.
I don't care about that. Adjust for the
Margin
stock
debt
market.
as a percentage of GDP?
Don't come to me with that nonsense. Give me the stock
Why?
market cap. Because the market cap relative to GDP is near all-time highs. Why would you adjust margin debt for GDP? It's not relevant.
It's just a way of thinking about the
nonsense.
level
Listen, the point
of
remains.
speculation relative
The point
to the size
remains.
of the economy.
The point remains. There's a lot of speculation out there. And so, yes, this can continue. We could be up 25% before the year is over. Who the hell knows? So I'm not saying like panic, sell your stocks, like, but maybe.
So what are you saying? What should people do?
I'm saying that if you are thinking about putting on a new position because you feel like you missed it and you feel yourself buying out of the fear of missing further gains, if you feel that impulse, take a beat.
Okay, what about existing positions?
That's up to you. That's, use your own risk management. I'm not, whatever. I did a little bit of shaving last week. A little bit of shaving.
Yeah, I sold a bunch of stuff, like some shares of things that I'm keeping, or just like outright got out of things that just were a waste of time, like Pfizer. And I'm not like looking for like, ooh, what's my next stop? Because I hate it when the market is so extended. It's been above its 50-day moving average for 3 weeks straight, and it's just like you feel like there's nothing to buy. Now things are starting to get interesting again, with all of these earnings reaction blowups in like really good companies. And I'm just like sitting back, and I want to see if some opportunities get created.
Guess what? I guarantee they will. I mean,
well, they are already, but like we're gonna get what did they say? 160 reports this week. Like we might have seen nothing yet.
Just don't feel like you're never gonna get another shot. Is what I'm saying. Okay?
Yeah.
Just take.
And
a
by
beat.
the way, unless you are fully invested with every dollar you'll ever earn, and you'll never have a fresh dollar to put into the market, this is great. All right, mystery chart.
Okay.
John, please. What is this?
Okay. Oh, I know what this is. This is the 2-year.
So close.
Okay. 10.
No, wrong direction.
Okay. 3 month.
Fed funds.
All right, whatever.
Reveal. You were close, dude.
That was
you were close.
that was embarrassing.
All right. There's a Fed meeting tomorrow. I think we're almost out of time to discuss it. Put that chart back up, please, guys.
This is a big L for me. I mean, my God.
You should like. I feel like everyone working in investing should like sort of be able to do that, right?
I'm ashamed. Yes.
So we're showing you guys the federal funds effective rate, and we're hovering just below 5%. And I don't think we get a rate cut tomorrow, but maybe they use the presser to set the stage for the September cut, and they'll use August, the Jackson Hole convention, to like kind of reinvest in the messaging from tomorrow. But that's sort of what's going on. We have one more chart. All right, so this is Fed funds rate expectations. So you can see the blue diamond represents the FOMC's own year-end estimates. The green diamond is market expectations, which you could see fell all the way down to, for 2026, fell down to 3%, but have since been rebounding, meaning that we think terminal rate is probably higher rather than lower. And the FOMC's long run projection is about 3%. So we're far away from these projections. If they're going to start cutting, they better start soon. And they might have to at some point. But right now they don't have to, and they're not. And tomorrow's probably another non-event. What do you think?
Nothing.
Is there anything he could say? Is there anything he could say that you think would be a surprise in either direction for the market?
Oh, there is absolutely anything he could say.
Like, what if
is there anything that he will say? What if he's
super dovish? What if it's a dovish hold and he's like, yeah, listen, we could totally cut rates, like not in those words, but like if that's what he implies.
I think it's going to be a lot about tariffs now that there's more clarity, right? Because that was the unknown. That was the only reason why they weren't cutting rates. So
they're gonna ask him 10 different questions about what did the president say to you behind closed doors and blah, and do you have any plans to leave before May? And it's gonna be like all the drama is gonna be about like them trying to get him to say something about Trump, and he's too smart for that.
I am not a Fed watcher. I will not be tuning in. I'll see the highlights.
Not this one. I watch the good ones. This is
a nothing burger. That's right.
All right, guys. Thank you so much for joining us and making this show the platform that it is. Love everybody who comes to the live on YouTube. That's 5 p.m. every Tuesday. Those of you listening, thank you so much. We appreciate you as well. And you can always catch the video replay. And it's just it's unbelievable how much engagement and how much you guys are responding to the show. So we love you for that. Tomorrow is Wednesday, which means it's an all-new edition of Animal Spirits starring Michael and Ben, my personal favorite podcast. There'll be a new Ask the Compound. And at the end of the week, we've got an all-new Compound and Friends with a returning champion guest. So from all of us here at the Compound, we thank you. We appreciate you. Leave a rating and review, and we'll talk to you soon.